And I had the real estate dealers and the real estate professionals on the hit list, so I want to talk about both of those. But if we look at the capital gains taxes, and this is the one that I said when I had the 3.8% surtax up there, that it can apply to the sale of a personal residence, but we need to do some planning. The current law is that if you are single, you can exclude up to $250,000, $250,000 of gains from the sale of your primary residence. And if you're married and you file joint with your husband or your wife, you can now double that to $500,000. Okay, so what does that mean? Well, that means is that if you're single and your house is under $250,000 of a market value, you're not going to owe any tax as long as you follow these rules. And I'll explain what the rules are in a second. But the same thing again on the married couples. So we want to be taking a look at that. But before we can look at the surtax, or before we can look at any taxes, we've got to figure out what is our capital gain. And so of all the slides that I have, I think this one is the one that I would focus on, or at least one that you can use for your own planning. And understand that this is an estimate, and it works for any stock or other capital asset. It works for real estate, it works for your primary resident, it works for your vacation home, it works for rental properties. So this particular slide works for any capital asset. And so we go on the left side and we say, what is our sales price? So we're going to do a real estate transaction. What's the contract price? What's the buyer agreeing to pay? So we put that in there and we back out our selling expenses. Okay, so we're going to take out the commissions that we pay. Or if you look at the HUD-1 statement on the seller's side, it'll have a lot of different expenses. All those come out of there. We subtract our adjusted basis and we get our capital gain. So the left side is crystal clear except for this adjusted basis. What does that mean? And so there we go to the right side. And we look at what we paid when we bought the property. So we want to go back to the HUD-1. Or if it's a stock, go back to the brokerage statement that shows the buy. Add to it any purchase expenses, maybe a commission in stock, any of the buyer's expenses in real estate. Put all that together, add in the capital improvements, which is only for real estate. It's not going to apply to stocks or bonds or what have you. Subtract depreciation, and we get our adjusted basis. Okay, so when we do the right side, we take the adjusted basis, plug it in on the left side, do the subtraction, we're going to get the capital gain. Okay, if it's a loss, obviously we have different rules. But if it's a gain, we have to say, all right, how long did we hold the asset? A year and a day or more? It's long-term. 1 year or less? Short-term. And that's going to be our tax hit there. So we're just going to take the capital gain, multiply it by whatever the percentage happens to be. Now, this has to happen, in my opinion, before you sell the asset. In other words, if we have a piece of real estate, we want to run this analysis before we even list the property, because we want to know if we get our sales price, our list price, or if we get 5% less or whatever our assumptions are, what's the tax hit going to be? Because if you find out that you're thinking you broke even, and this happens in rental properties all the time. I buy a place for $100, I sell it for $100, I think I have no tax bill, but I can because of the depreciation. So we need to be aware, even in a situation where it seems like we have a wash, it is possible that we could have a tax to pay. And if that's the case, we want to know, should we do a 1031 exchange? The like-kind exchanges that GK was talking about. Should we do that? Well, if we've already sold this property and it's under contract and we've gone through closing, it's too late. When you find out that you have a $50,000 capital gain and you should have done a 1031, you need to know that before you sell the property, before you list the property. Okay, so we want to know what the tax hit's going to be so we can decide if we can do anything about it. And a lot of times we can't. But if we can, the planning is now, not retroactively. Okay, now the basis issues, I think this becomes real important because what happens if we go back to this last slide and we say, all right, what's the sales price, what's the purchase price? What happens on the right side if we didn't buy it? Well, how did you get it? Well, we inherited the property, or we got it as a gift, or it was the replacement property in a 1031 exchange. We need to know that. And again, when I walked in before and GK was talking about a difference between a gift and an inheritance, it can be huge, not only on the capital gain side, but potentially on the estate side as well. Understand that on the inherited property, it's the value on the date of death. Okay, so I have an asset that I bought for $100,000. It's worth $500,000 today. I have a $400,000 gain if I sell it. If I give that asset to you, let's forget gift tax right now, I give you that asset that I bought for $100,000 and is now worth $500,000, you get my basis. So your basis is $100,000, you turn around and sell it the very next day, you're paying tax on $400,000 of gains. Okay, we haven't accomplished anything. Same situation, but instead of me giving it to you, I die and you inherit it. Your basis now is the value on the date of death. So my $100,000 basis gets stepped up to $500,000. You sell it for $500,000 the next day, you pay no tax, zero. Okay, so we need to do long-term planning. We need to understand how gifts, how inheritances, how like-kind exchanges, how different assets can be treated for tax purposes. And when you start looking at the tax code, there's a lot of these different areas in play. And of course, a lot of them don't apply to the middle class, but some of them do. And we need to be taking advantage of these so, again, we can understand what we need to do from a tax perspective. Now, the primary residence, I put this in here again because I've said that the 3.8% tax can apply. So we know that it can apply here, but what do we have to do to get it to work? Well, we've got an ownership test and a use test. Understand this is only on our primary residence. I'm not talking about a second home, a vacation home, an investment property, a rental property. I'm talking about our personal residence. Left side of the equation, you have to own the home for 2 years of the 5 before the sale. And the right side is you have to use that home as your main home for 2 of the 5 years before the sale. Notice there's a plus sign in the middle. Okay? So that means we got to have both. If you're missing the left or the right side, you lose. So what does it all mean here as far as the taxes go? Let me get to the exclusion and I'll go back then. The exclusion, if we're single, $250,000, married filing joint, $500,000, and you can only use it once every 2 years. Okay, so what does this mean? I have a house that's worth $600,000. I paid $300,000 for it. I've been in the house for 10 years, and I'm married. That $300,000 gain, when I sell it, is gone. I don't pay tax on it at all. And I can do anything I want with the money. It used to be that I had to roll the money over into a bigger and better house, or at least more expensive. I don't have to do that anymore. I could close on my property today, take the $300,000 profit, and come over here, and if they'll take the bet on a roulette wheel, I can do that. Okay? So there's nothing that I'm not legally obligated to invest in real estate or anything else. So if we go back to this slide then, you can see that the ownership and the use test become absolutely critical. And here's one of the problems with the personal residence. How do we protect our personal residence? I've got it in my name, or I've got it in joint tenancy, or I've got it in whatever, tenancy by the entireties, common, whatever it happens to be, but I don't have it in an entity. So now I put it into a family limited partnership, whatever the entity happens to be. I just picked that one because it's a common estate planning technique. Now, I no longer own the home. Okay, the family limited partnership owns it. So what happens when the family limited partnership sells it? They don't get the exclusion, and we're upping our capital gains, which may be okay, but you better know about that going in. Because if you have a $500,000 capital gain, by putting it into the family limited partnership, you've just cost yourself at least a $100,000 tax bill. And so what a lot of folks will look at, and they'll want the insurance component of the FLP, saying, I want a limited partnership. I don't want this asset to be taken away from me. And by doing so, they've incurred some very bad tax planning. Same thing if the family limited partnership owns the house, you may be denied the mortgage interest deduction or the real estate tax deduction because you don't own them anymore. So understand that if you do one thing with the asset protection or the estate planning side, it may have an unintended consequence on the income tax side or upon the tax side in general. And so planning, I think, in all fronts needs to happen so that you don't get into one of these situations where, oh man, if I would have known that, I wouldn't have done this. Let's make sure we cover those situations before it becomes a problem. So a couple things with this slide. You see the 2 years on each side. Understand that they don't have to coincide, meaning that I could rent my place for 2 years, so I'm living there for 2 years, then I decide to buy it, and then I rent it out for 2 more years to somebody else, right? So now I own the place. I've owned the place for a couple years. I've used it as my residence for a couple years, but neither were at the same time. They didn't ever owned it and used it at the same time. So they don't have to coincide at all. The other thing that you need to be aware of, and this applies to any tax rule, is if you don't like the tax rule, and believe me, there's a lot of tax rules that you don't like. You may not know about them all, but I could tell you a lot that you don't like. Okay, you just don't know it. But if you don't like the rule, your first thought should not be, oh man, you know, I'm burned again with the taxes. Your first thought should be, how do I get around it? How do I get around this rule? Because I don't like it. It doesn't play out too well with me. Well, I haven't lived there for 2 years, and I've sold my house, or I haven't owned it for 2 years, and I sold my house. I've got a capital gain that I've got to report, unless there's an exception. So my first question to my clients in this situation is, why'd you move? Oh man, I got this great, I'm working for IBM, I got this great job offer, and I got transferred. Great. Change in place of employment. That's an exception to it. So if I live there for 1 out of the 2 years, or half the time, and I'm single, instead of getting $250,000, I'm going to get $125,000. In this market, or in most markets, how many houses are going up $125,000 in a 1-year period? Right? It doesn't happen that often. So we want to look at this. Now, I also put can be voluntary. What does that mean? Well, let's say that I'm tired of living in Denver. I've lived in my house for just a year now, but I really don't want to live in Denver anymore. I want to move to Las Vegas. So I move. Nobody transferred me. Completely voluntary. It's still a change of place of employment. We also see situations with health issues and this quote-unquote unforeseen circumstance issue. Both of these come into play. And so we want to be sure that if it's a change in health, my house is at 8,600 feet elevation outside of Denver. Anybody been to 8,600 feet? Anybody know what the problem is? Right? I mean, my first month there is like, I don't know if I can lift this box anymore as I'm moving in, right? There's lack of oxygen. Well, that can also be a health issue if you have trouble breathing. And I've had two different situations with clients that moved to the mountains around Denver and realized that for health reasons they couldn't make it and moved. Actually, one of them moved right here, down getting into Las Vegas. And they get audited. How do you prove that you moved because of health? Self-serving statement, right? I moved because of my health. Wink, wink, so I don't have to pay the tax. Right? So you better, if you're going to use this change of health, you better get an excuse. Right? Get your doctor to write up something. Because you know what's going to happen. The minute that you get that audit letter from the IRS and you don't have this letter from the doctor saying why your health required you to move from wherever, you're stuck. You go back to the doctor died, right? The doctor's out of business. Doctor's in jail. I don't know. But the bottom line is you can't get it, and you're not going to be able to prevail there. And the IRS is huge, huge with the records. And so if you can't prove that, you could be talking about a big bill. Unforeseen circumstances. And the IRS has come up with these, and they've been giving us guidance all along. And surprisingly, the IRS is very liberal when it comes to unforeseen circumstances, meaning they're giving taxpayers a lot of breaks. Okay, so I just bought a brand new house. I'll give you some of the examples that they had. I just bought a brand new house. I'm coming home. I put the key in, and before I can get the door open, I hear a click at the back of my head, and it's somebody with a gun. Okay, so they tell me to lay down. They rob me, and fortunately, they don't kill me. I'm freaked out. I can't live there anymore. IRS says you're right. That's a change in circumstances. I'm single. I have a couple kids. I'm getting ready to marry Mrs. Brady, who also has a few kids. right? So we're going to form the Brady Bunch, have 6 kids, but guess what? I don't have enough room in my house, and neither does she. Change in circumstances. Again, and you see, this can be my voluntary. Don't think of change in circumstances as necessarily something bad, okay? But a lot of different plays come in as far as what we can do here. I'm a police officer, and the city of Las Vegas requires me to live in Las Vegas, so I have to move. Unforeseen circumstance. Okay? And the list goes on and on and on. So if you don't like this law or any other tax law, before you give into it, you need to say, where's the loopholes? How can I get around it? I don't like that. And be vocal about it, because there are a lot of loopholes in the IRS gray area of taxes. Okay, I mentioned what the primary residence is for the $250,000.